Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
$1.02. That's where Interactive Strength, ticker TRNR, is sitting as of mid-January 2026. But honestly, if you're looking at the tape, that price point is almost irrelevant compared to just the violence of the volume. We're not looking at a standard micro-cap chart here. We're looking at a battlefield. The carnage is absolute.
A battlefield implies there are two sides fighting. I'd argue what we're seeing here is more of an execution. I mean, let's not bury the lead. Look at the flow. On January 2nd, 2026, the short volume ratio hit 73.24%.
73%?
Yeah. So nearly 3 out of every 4 shares sold were sold short. And this is all happening after a cumulative 1 for 1,000 reverse stock split over the last 14 months. So if you had 1,000 shares in late 2024, today you hold 1. This isn't just volatility. This is capital structure pathology.
And that is exactly the question, isn't it? Is TRNR Hothnar a terminal equity entering a final death spiral to zero, which that short volume would suggest, or is it one of the most misunderstood, special situation arbitrage plays on the market poised for a massive re-rate? I'm leaning toward the great escape thesis. Between the sports tech foreclosure and the Fetch.ai crypto treasury, the company is sitting on some massive asymmetric upside that the market is just blind to. You have analyst targets at $8.50, even $15 for a reason.
And I'm firmly in the liquidation spiral camp. You can talk about analyst targets all day long, but the balance sheet is technically insolvent. They have cash under $1 million against over $70 million in liabilities. The toxic convertible debt structure is actively capping the stock, and frankly, the leadership has gone scorched earth. To me, this equity looks completely uninvestable.
Okay, I get it. The trailing 12 months look like a disaster movie, but you're pricing this based on a hardware business that, for all intents and purposes, doesn't really exist anymore. The market is treating TRNR like a failing exercise bike company. A Peloton wannabe that just missed the boat. But the reality is that it is morphed into a holding company and it's navigating a very specific, event-driven pivot. The core of my argument, really, it rests on 2 massive pillars. First, the sports tech foreclosure. We're talking about TRNR acquiring a company that generates roughly $13 million in quarterly revenue, and they're doing it for essentially the cost of a $6.6 million credit bid. That is pennies on the dollar.
If they can close it. And that's a massive if we need to unpack.
We will, but you combine that with the crypto treasury strategy. They've accumulated 59 million Fetch.ai tokens. I mean, that holding alone is valued at around $17.28 million. That is a balance sheet hedge that correlates with the AI boom, and it's completely distinct from the struggles in the fitness sector. So when you do the math on the assets, the tokens, plus the sports tech revenue, the disconnect between a $1 share price and the potential value is it's over 700%.
I'm sorry, I just can't buy that valuation math because it ignores the mechanism that is actively grinding this equity into dust. You have to look at the capital structure pathology. This so-called death spiral financing is the only thing that matters right now. They're reliant on senior secured convertible notes that have floating conversion rates.
It's financing. I mean, it's expensive, yes, but it kept the lights on.
It's not just expensive, it's predatory. This structure creates a completely perverse incentive for lenders to short the stock, drive the price down, and then convert at lower prices to get more shares. It just effectively caps any rally. And your shareholders, they're down 96% in a year. That 1 for 1,000 consolidation means you have this massive layer of trapped longs who are just waiting for any liquidity to sell and get a few cents back.
The overhang is real, I'll grant you that. But let's dig into this death spiral claim, because people throw that term around without really explaining the mechanics. You're arguing the financing itself is the engine of the decline?
It absolutely is the engine. Let's break it down for anyone who hasn't been reading the S1s. These convertible notes, they don't really have a fixed floor in practice. When the stock drops, the conversion rate resets. And what that means is the lender gets more shares for their debt as the price goes lower. It's the complete opposite of shareholder alignment.
But that's a pretty standard term for distressed lending. When traditional banks won't touch you.
Standard for companies that are circling the drain, maybe. But just think about the incentives. If you're a lender or a fund associated with that lender, the rational move is to short the stock, what we call shorting against the box. You drive the price down, you wait for the reset, and then you convert your debt into cheap equity to cover your short. You've locked in a risk-free spread. That 73% short volume we saw isn't just a bunch of retail bears betting on bankruptcy. That is structural selling. And with borrow fees climbing to nearly 15%, supply is tight, yet the selling just persists. It's a machine designed to print shares and destroy value.
I'm just not convinced that's a terminal diagnosis. Yes, the financing is toxic, of course it is, but it was the only lifeline available to avoid immediate bankruptcy back in 2024. The company bought time. My argument is that the overhang of unissued shares is, it's a known quantity. The market knows this. The reason this isn't a spiral to zero is the sports tech deal. If that foreclosure goes through, you're bringing in $75 million in pro forma revenue. That kind of influx allows TRNR to go to traditional credit markets, refinance these toxic notes, and break the spiral. You're looking at the dilution. I'm looking at the value of the asset that the dilution purchased.
You're assuming they can refinance. But let's even look at the share count. You've got basic shares around 2.39 million, but the fully diluted count it's a ghost number because of these convertibles. Every single time there's good news, like the Watt bike deal or a crypto pump, the volume spikes and the price just gets crushed. Why? It's because the note holders use that liquidity to convert and dump their shares. The rally becomes the exit liquidity for the lenders. How does a regular equity holder ever win in that scenario?
They win if the asset base grows faster than the dilution. It's a race. And that brings us right to the sports tech saga. This is not a standard M&A deal anymore. This is where the thesis gets really interesting.
Interesting is one word for it. Legal brawl is another.
I'd call it a bold enforcement of rights. Let's set the stage. CEO Trent Ward advanced about $5 million in working capital to Sports Tech to keep them afloat. Sports Tech defaulted on December 30th, 2025. Now, usually this is where companies get bogged down in a messy merger negotiation. The target moves the goalposts. TRNR didn't do that. They are enforcing their security interest. They are auctioning the shares in February 2026. They're going to credit bid their debt.
Okay, we should probably explain that concept. Credit bid.
It's simple, but it's powerful. TRNR is owed roughly $6.6 million. So instead of paying cash to buy sports tech at the auction, they bid the value of that debt. It's like foreclosing on a house where you hold the mortgage. You just take the keys because they didn't pay the bill. This validates the bull case because they completely bypass the negotiation table and they take the asset by force. They're acquiring $13 million in quarterly revenue without spending a new dime of cash they don't have.
That is a very, very optimistic framing of what looks like a cross-border legal nightmare. This has turned into a hostile battle. Sports Tech is disputing the debt amount. They're claiming it's not $6.6 million, and you are dealing with a German entity. Have you considered the risk of German insolvency laws?
The loans were secured by a pledge of 100% of Sports Tech shares, plus personal guarantees.
But German law is incredibly strict on insolvency. If Sports Tech files for insolvency in Germany to block the seizure, which is a common defense tactic, TRNR is trapped. Insolvency proceedings in Germany are not like Chapter 11 here. They are slow, bureaucratic, and they're geared toward creditors, not equity holders. TRNR has less than $1 million in cash. They cannot afford a prolonged legal war in German courts. If this auction is enjoined or delayed, the liquidity dries up and the game is over.
That's a fair concern about the timeline, I'll admit, but the legal footing is strong. This isn't some vague contract dispute, it's a secured default. The foreclosure auction is the cleanest way to transfer title under the Uniform Commercial Code. And we have to remember, Sports Tech needs this too. They're the ones who defaulted. TRNR holding the keys to the equity gives them immense leverage. They are effectively the bank now.
Well, leverage requires cash to sustain the pressure. TRNR is running on fumes, and while they're fighting this war in Germany, they're simultaneously trying to execute this bizarre pivot to crypto. This is where I think the wheels just completely fall off the strategy argument.
I wouldn't call it bizarre, I'd call it asymmetrical.
I'd call it financial engineering. I mean, let's talk about this crypto treasury. They have a $500 million facility to buy Fetch AI tokens, and look who's involved.
DWF Labs. In the crypto space, DWF is known as a high-frequency market maker. This whole structure, it just smells like a complex derivative play, not a corporate treasury strategy. It turns TRNR into a proxy for Fetch AI volatility. If I wanted to buy Fetch, I'd just buy the token. Why would I buy a distressed fitness company to get exposure to it? It introduces a correlation risk that has absolutely nothing to do with selling exercise bikes.
That's an interesting point, though I would frame it very differently. This is the AI x fitness narrative. We're moving into an era of decentralized agentic technology. But put the tech buzzwords aside for a second and just look at the balance sheet mechanics. It's the MicroStrategy playbook.
Oh, here we go. Everyone thinks they're Michael Saylor now.
But look at the math. MicroStrategy used capital markets, debt, and equity issuance to accumulate Bitcoin. TRNR is using its structure to accumulate a high-growth asset. They have 59 million tokens. If that token doubles, which is not at all uncommon in crypto, that creates $17 million in immediate value. That solves their liquidity crisis much faster than selling treadmills ever could. It's a hedge against their operational difficulties. It separates the company's survival from the quarterly sales of hardware.
MicroStrategy had a software business generating stable cash flow to service its debt. TRNR has a hardware business burning cash. Using toxic debt to buy volatile tokens is gambling, plain and simple. If crypto enters a bear winter or if that token drops 50%, TRNR is left with the debt and devalued collateral. It magnifies the insolvency risk. It doesn't hedge it. You're adding beta on top of beta. You're taking a company that is already risky and strapping a rocket booster of pure volatility to it.
It magnifies the variance, certainly, but that's why the upside is 700%. You don't get that kind of potential return without variance. And this aggressive posture, it comes right from the top. We have to talk about Trent Ward.
We certainly do. I find his governance approach alarming. While shareholders have lost 99% of their value, his base salary went up to $300,000 plus a 75% bonus target, and his communication style is, frankly, scorched earth. His public letters about sports tech were incredibly combative. He accused them of seller's remorse, threatened aggressive action publicly. In the corporate world, that kind of behavior, it scares off future partners. I mean, who wants to do a deal with a CEO who will drag you through the mud in a press release if things go south?
I just see that aggression differently. I interpret Ward's behavior as necessary for a distressed turnaround. Look, a polite, passive CEO would have let this company die in 2024. Ward is fighting. He's using every tool he has, foreclosure, crypto pivoting, toxic financing, to keep the equity alive. The pivots show that he and the board are aligned in taking these high-risk, high-reward swings. They aren't trying to manage a slow decline. They're trying to engineer a breakout. You call it scorched earth, I call it battlefield command.
There is a very fine line between fighting for survival and reckless endangerment of the remaining capital. The fact that the board approves these death spiral financings suggests they're either captive to its vision or they're just out of options. And regarding the trapped longs we mentioned, the retail investors on StockTwits and Reddit, they're exhausted. They see this compensation increase, the reverse splits, and they feel scammed. That sentiment creates a ceiling. Even if Ward pulls off a miracle, there are thousands of investors just waiting to sell the moment they see green.
And yet, new investors are entering. The volume tells us that. The crypto speculators are starting to watch TRNR as a leveraged bet on the token. If the narrative shifts from failed fitness company to AI and crypto holding company, that retail sentiment can flip overnight. We've seen it happen before. Sentiment follows price, not the other way around.
You're banking on a narrative shift to save the fundamentals. I'm just looking at the math. The borrow fee is double digits, the cash is gone, and the litigation is cross-border.
So we are clearly looking at two different horizons. I'm looking at Q1 2026 as the event horizon.
I agree on the timing, just not the outcome.
Okay, so let's summarize where we stand. This is a binary investment. There really is no middle ground here.
Completely binary. You either zero out or you get a multi-bagger.
On my side, you have scenario A, the great escape. The sports tech option in February succeeds. TRNR takes the asset. At the same time, the crypto treasury appreciates. This lets them refinance the toxic debt, stopping the dilution. The stock re-rates toward that
Say $5 to $8 range as the market realizes the bankruptcy risk is off the table.
And on my side, scenario B, the liquidation spiral. German litigation stalls the foreclosure. Sports tech blocks the seizure. TRNR burns through its remaining cash and is forced to issue massive amounts of new equity at 10 cents, 5 cents, just to pay the lawyers. The death spiral accelerates, and we see another reverse split or a delisting. The stock just drifts to zero.
For the risk tolerant, I look at the asset value relative to the market cap, and, well, the asymmetry is compelling. If the foreclosure works, you're buying $1 for 10 cents.
And I conclude that the structural headwinds, the dilution, the legal risks, they make the probability of success just too low to justify an entry. You're picking up pennies in front of a steamroller.
Well, the market won't have to wait long to find out. Q1 2026 is going to decide the fate of Interactive Strength.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching, and see you next video. Bye-bye.